Good morning, YouTube. Today we're just going to talk about some of the confusing things happening in the market and some of the reasons why you're getting one group saying the market's going to go up, another group saying the market's going to go down, one group saying that you have inflation that's going to go skyrocket, and another group saying, hey, your inflation's going to go to nothing, it's going to be deflationary, and we see these signs. And pretty much it sums up to being people are seeing what they want to see in the market, and what we have to do to make money is we have to observe the market as an objective person and say, what is happening in the market now? What do I think is going to happen based on what's happening? And how would I react to that to increase my profits? So we can get right into this now. First, let's talk a little bit about interest rates. Interest rates, they said the base rate was at 2.25 today, and it's going to be held at 4% through 2023, which means an increase from at 2.25%, 2.25 to 4% over the next year. We know that's going to happen. The Fed has said that. They're trying to create a stable platform for the markets to react rather than them overreact with uncertainty. That creates a commercial rate of 5 to 5.5%, and next year a commercial rate of like 7%. A 30-year mortgage is at 6% now, and in a year it'll probably be at like 8%. Depending on what they expect for long-term rates, that's not exactly fixed, but we'll say 7 to 8%. And so you say at 7 to 8%, what will happen with the money supply? Well, if you were following traditional money theory, then the increase in interest rates would decrease the money supply. Therefore, you would have less money available. Now, that is not what they're following anymore. They have created a new thing called modern monetary theory, which basically says that the government can print money at an endless scale without affecting the value of the money. Now, that doesn't seem logical and doesn't sound like what I would believe, but let's just observe the factors and then see maybe if we can draw some conclusions about what might happen. And so if you go down here on house demand, I went to a house the other day, they had 12 offers. So house demand is not lower, okay? But the amount of house people can afford is higher. So the person that did afford a house that cost $350,000 might be buying a house now that costs $250,000, which increases the lower end demand on houses, which therefore increases the prices somewhat on that. What do I think will be in a year? Well, especially in our area, I don't think it's going to go down at all. You're going to have 12 offers on both. I don't think the demand is going to go down at all, but how much house people can afford will go down, so the demand in higher end housing is most likely going to go down because there's less people that's able to buy that housing now, and so that could lead to a decrease in the average value of houses that's selling. Now, in actuality, a house that did sell for $200,000 might sell for $225,000 in a year. But a house that was sold for $900,000 might now sell for $750,000. And so that we'll see as a decrease in prices, even though if you were in the $200,000 house, you might actually have gained 10% improvement in the price of your house if you were selling in the market. Now, the interesting thing is that house demand does not track duplexes and quadplexes, okay? So if you think about rents, this house demand, how does that affect rents? Well, rents right now on this similar house is about $1,400. What are they going to be in a year? Personally, I think they're going to be $1,400. Now, what is going to happen, I think, to balance this out is that, and I've already seen it happening, duplexes and quadplexes will come on the market, and they will be able to be purchased for cheaper. And the reason is because this 7% interest rate creates a problem for people that own duplexes and quadplexes. or people that own things in LLCs, because that money is generally 5-year fixed and it's going to come up to them, and they're going to want to sell out of some kind of property so that they can pay down their debt so they don't get smacked with that 7%, because the internal IRR or rate of return is not 7% on rent. And so they're really going to be losing money at that. And so I think the rents are going to stay stable, and the reason is because of those duplexes and quadplexes that are coming on the market at a discounted rate. Now, the counteracting factor is, if people can't get houses, they're going to increase the demand for rent, so that might cause it to go up. So let's keep talking about this. Green spending. A whole bunch of money is being spent on green technologies. How that's going to affect? Well, the money supply here, in general, when the interest rates increase, is supposed to go down. Now, it hasn't, because the government has actually increased their spending. What it takes over all the money that was not being spent in businesses and personal because of the interest rate risks. And what you'll want to see is that is kind of a move towards socialism and increasing the power of the government, which is what the Democratic Party is pushing. They're pushing more socialistic programs and increasing the power of the central government, which you've seen through their policies. And so the spending will move from you and businesses spending money to the government spending the money. And I think the actual supply of money is actually going to increase. And so how does the 8.5 to 9.1% inflation get affected? Well, I don't know, because your money supply is not going down. And old monetary theory says your money supply causes inflation, and new monetary theory says, hey, you can print as much money as you want, and it doesn't cause inflation. What causes inflation is your individuals and businesses spending the money. And so how will that work out? I don't know. I don't think inflation. I think inflation is going to go, maybe stay similar. I think it will actually go down a little bit. And the stock market is reacting to one thing, I think. It is reacting to expected interest. Now, expected interest basically establishes a zero risk internal rate of return for your money. And so if your 10-year treasury is at 3% and a stock was at 3%, the stock has risk that is actually paying less than 3%. So people are going to shift their money from that stock to the treasury. Okay? Now, the treasury goes to 4%. Now that stock at 4% is worth less and has to decrease in value based on the internal rate of return. So I think the stock market is reacting to expected interest rates only. And so when inflation is high, they expect interest rates to go up. When the market or the interest rate, people that set the Fed says interest rates are going to go up, the market goes down. So anytime you want to understand what the market is going to do, you only look at the change in expectation of the interest rate. Okay, so if you look at the market and the interest rate expectation is 5%, and you think that the real interest rate is going to be 7%, then you would not buy into that market unless you're doing a dollar cost average for a long term, right? But because when the market sentiment changes from expected interest rates being 5% to being 7%, everything has to adjust based on the IRR. And that is how the stock market is pricing things in. Okay? So the way that ties into inflation is, let's say through next year they have, this 2% increase, and this is where we are, just like they said. And inflation doesn't get touched. Then the next step they're going to make is not going to decrease the spending. Okay, they're not going to decrease the spending until you change your government. What they're going to do is try to increase, they're going to say this didn't work, and they're going to try to increase this base rate above the inflation percent. Okay, that's the next step. And so let's say we get to mid-2023 and your base rate's at 4%, just like he said. He says it's holding up to end 2023. Now he gives a new expectation. Let's say your inflation's still at 9%. Okay, his inflationary prediction might be that he's changing the base rate from 4 to 9% because 4 hasn't controlled inflation. And he wants to get inflation under control. Now, that would cause the stock market to crash. Because when their expectation goes from this 4% base rate to a 9% base rate, your IRR changed. Your base expectation changes, and so you say, now treasuries are paying 6%. So if I have a dividend stock paying 4%, that dividend stock now has to adjust down in value by 75% or 50% so that it now pays an IRR equivalent or more than the risk-free treasury. And so that is what you're seeing in the stock market is, on the old sense, this interest rate caused inflation to change. Now inflation is caused by your money supply, and the money supply is still increasing, it's not decreasing. And so this inflation rate is probably not going to be touched. But the thing that you can do to make money is to watch this inflation rate and understand that if it does not come down significantly to under these rates here, so if it's at 5, you're probably okay. But if it's at 7, 8, or especially 9, then he's going to have to increase this rate in 2024. And once the market gets that expectation, the IRR will change basically the value of the companies that you have on the market. And so that's kind of what I see is happening. I kind of explain it to you because as I explain it to you, I think through it for myself. And so I think that my actions will be, I did sell some Home Depot stock when it got up to 321, so that if it went way down like it is, I could buy more. But I think my action will be that if the market's expectation gets where they're expecting this to be all they're going to be, or maybe it's going to lower this based on something and it raises it, I will probably sell out of some of my position, and I'm not saying sell at 100%. I'm selling, maybe I'll sell 15% or 20%, so that I have the opportunity when the stock market goes down significantly to buy back in. Okay, I will probably continue my DCAs, but I'm also going to decrease those and shift some of my focus over to real estate to put myself in a better position regarding these interest rates, because at a certain point you can own an index fund paying 1.75% interest, or you can own a treasury paying 6% or 7% or 8%. And so that's definitely going to affect the value of that index fund, because people are going to move things into something that's paying them more money, and moving things decreases the values of what you sell. And so that's just how I see it. I wanted to take time today to explain to you, kind of what I saw, what actions we could take, and what those actions might be based on that everybody else doesn't see. And so I think everybody else is kind of watching the stock market so that they can get an idea of when to buy and when to sell. And so when everybody sells, they feel like they should sell. When everybody buys, they feel like they should buy. But you're better off to kind of in your mind get a gauge on the expected interest rate and say, do I expect the interest rate to be higher than this expectation or lower? And if you expect it to have to go higher, then you would be bearish on the market. You think it was going to go down. And if you expect it to not need to be as high, then you would be bullish. And you would be ahead then of the stock market jump up and down. And so that's how I see the situation. I just wanted to take time to make sure you understood what I was looking at. And again, I'm not an advisor, but this is what I'm doing. And thanks for your time today. Like and subscribe if you do. Enjoy the video, and I'll talk to you later.